Thank you for joining us for our 4th annual Strive Symposium. We are going to paint a rather bullish picture of our performance in 2020 as well as our outlook in 2021. However, we are very sensitive to the hardship that the pandemic has caused. We have felt it ourselves. We are, like you, trying to balance being a forward-moving, hardworking, focused, strategic advisor to you, and balancing that with being sensitive to the pandemic, being very aware of the health of those within Strive, in our families, and really in our greater community. With that, I have a very exciting announcement. We have given the title of partner to Adam Gottschalk in our firm. If you haven't worked with Adam, I will share with you that he is conscientious and hardworking and kind, and he upholds all the pillars that we hold high at Strive. If you get a chance to visit with him, please congratulate him. Jason and I could not be more pleased that he now holds the title of partner in our firm. Before we jump into the program, I would like to mention one of our sponsors, Republic Title. So we did, I think, about 77 transactions last year, and the majority of those we did with Republic Title. And the reason is because they are efficient and they solve problems before they happen. They have 2 closers on every deal that we do with them, and they have a slew of attorneys on staff. They've really become like an extension of our company at this point. They're very responsive to phone calls, and they help us look good. Thank you, Republic Title, for really being a partner to Strive over the years. So in recapping, inside Strive, we cover the state of Texas, and as is our legacy, we sell retail single-tenant properties. We also sell multi-tenant experiential retail properties. 2 years ago, we added a vertical for office investment sales, so we now sell office properties. And just last year in 2020, we added the vertical of industrial investment sales. The theme for our symposium this year is A Rising Tide Lifts All Boats. And we chose this theme really thinking about the state of Texas. And then more specifically, the inertia behind the theme comes from a story about Dallas-Fort Worth. So this slide shows the year 2000, and the dinghy is Dallas-Fort Worth as a city. Not bad, it has a motor, but it is a small boat. It's holding 2 people, and we are moving on a forward trajectory for sure. However, I was at a national event at my previous company in the year 2000, and there were people from all over the US, and I was in a retail breakout room, and there were 5 institutional investors on the panel. And somebody in the audience asked the question to the institutional investors, where are you trying to deploy capital this year? What are the primary states or cities that you're focusing on to put money out? They all named the usual suspects like New York, San Francisco, Los Angeles. One guy said Chicago. I think one person even said Houston, Boston, all of the major markets that you would think people were trying to deploy capital at the time. But nobody mentioned Dallas-Fort Worth, so I raised my hand and I said, are you targeting Dallas-Fort Worth to deploy capital? And they all just sort of smirked. I mean, I was a kid at the time. This was 20 years ago, and they're all kind of shaking their heads. And then I wouldn't let it go, and I raised my hand again, and I said, okay, well, how do you consider Dallas-Fort Worth? Do you consider it a primary market? Do you consider it a secondary market? 3 of the guys on the panel said that they considered Dallas-Fort Worth a tertiary market. 2 of the guys said they considered it a secondary market. So, as you can imagine, I was not pleased. However, fast forward 20 years, And this is where we are today. We are definitely on the map. We are, by all standards, a primary market. There is capital coming from all over the U.S., targeting Dallas, Fort Worth, Houston, Austin, really the state of Texas. And there's international capital now targeting the state of Texas. So none of this, of course, happened by accident. Over the last 20 years, the governors of the state of Texas, as well as the individual mayors in each city, they went on roadshows and really recruited companies to come to our great state of Texas, either for a regional headquarters or to move their main headquarters to Texas. And we saw that happening all over our great state. You can see from this slide all of the major companies that are either have their corporate location in Houston or they're regionally located in Houston. And clearly, there are a lot of Fortune 500 companies on this screen. Most of them are Fortune 500 companies. And same thing in Dallas, Fort Worth. These are companies that are either regionally located or headquartered in Dallas, Fort Worth. Many of them are new, and most of them are Fortune 500 companies. Now I'm going to hand it over to my partner, Jason Vitorino.
Texas is now home to 49 Fortune 500 companies, more than 1,400 foreign companies, and 2.4 million small businesses. DFW has 23 Fortune 500 companies, the third largest number of Fortune 500 headquarters in the US, only behind New York City and Chicago. Additionally, nearly 200 companies have relocated their headquarters to Texas within the past decade, and a large number of those companies were previously stationed in California. Texas held the #1 rank for attracting California companies for the last 12 years straight. And why is this important? Because roughly 660 California companies moved out of that state in just the last 2 years. This slide epitomizes the current situation. This is a live shot of Elon Musk packing his bags, filling his U-Haul, and moving to Texas. Allied Van Lines annually produces the Magnet State Reports, which contains insights about migration across the U.S., tracking how many trucks enter each state as opposed to leaving them. In 2019, with no surprise, Texas was #1 for corporate moves. In 2020, again, Texas and Florida were at the top of the list. Florida for consumers, with Texas being a close second in that category, and Texas in first place for corporate moves. Texas has ranked the top move for corporations the last 7 years. I'll repeat, Texas has more corporate relocations than any other state in the U.S. for the last 7 consecutive years. Companies are moving to Texas in record numbers. Houston's the top city for corporate moves for the last 2 years, and Texas cities have dominated 3 of the 5 top 5 spots. Top city for consumer moves, Austin, and they've held this title for 3 years in a row, making Austin currently the nation's fastest growing city. Corporate reloads are on the rise, and some industry experts predict 2021 could be the biggest year yet for corporate immigration to Texas. Among the companies that have moved to Texas include Charles Schwab, AT&T, Toyota, McKesson, PGA of America. Even the popular video app TikTok is considered moving their headquarters to Texas. There is a tech exodus from the Bay Area. Currently, Texas and Florida are powerful magnets for tech jobs at the expense of California's Bay Area. Governor Abbott called it an absolute tidal wave. With over 40 companies having relocated or opening new facilities in Austin in 2020 alone, Austin has now become known as Silicon Hills. The likes of Tesla, Apple, Facebook, Uber, Google, all have recently expanded their operations in the Lone Star State. So why are companies moving to Texas? Higher quality of life, lower cost of living, affordable housing, business-friendly climate, limited government regulations, better tax laws, fewer restrictions, no state income tax, centrally located in the U.S., close proximity to ports, just to name a few. And what does this all create? Jobs, jobs, and more jobs. But because of COVID, Texas actually lost 3.7% jobs last year. And although negative, it was only 1/3 of what California and New York lost. The Texas economy, by virtually every metric, has been very strong, and without this global pandemic, we most certainly would have added more jobs again this year. Another result of the pandemic, many firms have implemented a successful work-from-home strategy. Furthermore, several tech companies even said they would give employees the option to permanently work from home after the pandemic ends. So one might ask, how will these corporate reloads lead to population growth if everybody can just work from home? Well, one is once the effects of the vaccine kick in, more people will be going back to their office. And two, guess where the best place to work from home is? Texas, where else? Additionally, in 2020, there were 5,300 business applications submitted in Texas, a 60% increase since 2019. Every state in the union saw double-digit increases in business applications other than two, California and New Hampshire. So as corporations continue to come to Texas by truckloads and companies expand here, it will ultimately create an abundance of jobs, which will lead to population growth, a need for more housing, for more medical services, more restaurants, schools, dry cleaners, nail salons, and so on and so forth. Back in the day, I asked a top client why he keeps buying commercial real estate here in DFW, and he responded, the population keeps growing and they're not making any more land. If we look at the most populous MSAs in the nation, it's New York, LA, Chicago, DFW, and then Houston. Chicago has declined since 2010, but on the other hand, DFW and Houston gained 1.2 and 1.1 million people respectively, a trend we see continuing. And at some point, we'll take over Chicago as the third largest MSA in the nation. Not only are we on the map, we're moving on up. Top 10 MSAs in numeric growth, as mentioned, DFW and Houston are number 1 and 2 in the country with over 1 million in population growth. No other MSA can say the same. Top 10 counties for numeric growth, Texas dominated 60% of this list with counties like Harris, Tarrant, Bexar, Dallas, Cullen, and Travis. We added almost 374,000 people in Texas from July 2019 to 2020. That's over 1,000 people a day moving here. Florida added 240,000. And as the map depicts, there were net outmigrations of 126,000 people in New York and 69,000 people left California. Top states for population gains, Texas, Florida, Arizona, North Carolina, Georgia, low-cost Sunbelt states leading the way. With plentiful employment opportunities and relatively affordable housing, this continues to drive the population in the sunshine states. The biggest losers? New York, Illinois, and California. These three states saw the most significant move-outs over the past year. Both Illinois and California have been at the bottom of the barrel for the fourth time in the last 5 years. Furthermore, California has experienced negative domestic net migration for years. For example, LA has seen net domestic outmigration every year since 2010. In 2019, more than 100,000 people left the state, the highest in the past decade. New York had the largest percentage and nominal population loss in the country. These numbers put New York's population basically even with 2010 levels. People are moving out of California and New York right now, and there's not any international immigration replacing them. But we're not so naive. We know that once travel commences again, we'll see foreign immigration come back to these states, but it will take many years for it to counterbalance the outmigration domestically. In other words, over the last decade, Chicago's population is declining, New York and LA is about even, while the population in Texas is booming. Ultimately, when the final 2020 census numbers come in, DFW and Houston will most likely top the list of metro areas for nominal population growth, and Austin and San Antonio will come in as two of the fastest growing cities on a percentage basis. So what are the fastest growing large cities in the last decade? Texas holds 3 of the first top 4 spots and 50% of the top 10. Frisco leading the way, and shoutouts to New Braunfels, McKinney, Cedar Park, and Conroe. Because of population growth in Texas, we just can't keep up with demand. Thus, we have the best apartment absorption rate in the country. DFW leads the way, and Houston's in the top 3. And not surprising, San Fran, LA, New York, and Chicago have substantial apartment vacancies, which are causing rental rates to plunge. Not only are apartments being absorbed in Texas, there's also a high demand for single-family homes. Home sales were up in 2019 and then again in 2020. With only a slight dip in April, May, and June at the start of the pandemic, we had an impressive surge happening in June and July, and by the end of the summer, year-to-date sales roared back, and the Texas market is poised for another consecutive year of annual growth. Home sales are up. Why? The reason is because bottom-out interest rates ignited a now-or-never mentality for potential homebuyers. Additionally, the largest cohort of homebuyers in 2019 and 2020 were millennials, a trend that should continue. And this bodes extremely well for Texas because we have a larger percentage of millennials in the entire U.S. than the entire U.S. as a whole. With the lack of homes on the market, approximately a 2-month supply, housing permits are way up in 2020 and are projected to be the same for 2021. And as I alluded to before, sales are up too, by about 10% in almost every market within Texas. Top housing experts predict Austin and DFW will be 2 of the best home markets in 2021. So how does this all stack up? If Texas were a country, we'd have the 9th largest GDP in the world. Corporate reloads, jobs, population growth, and home sales are all important indicators for commercial real estate demand. Per CoStar, in 2020, DFW was second only to New York with $22 billion in transactional velocity, and Houston ranked number 9 out of the top 10 with about half as much, or $11 billion in commercial sales. If you take the Real Capital Analytics survey, DFW was number 1 in transactions, followed by LA as number 2. Either way, Texas is completely a different place than a decade or 2 ago, and now we have several primary markets. DFW, Houston, and Austin are not only becoming more dominant and recognized for a place to invest domestically, but even on an international perspective.
So what does that mean for us in commercial real estate? More companies, Toyota in Dallas-Fort Worth, Hewlett-Packard in Houston, and Tesla in Austin, which also means more jobs, which of course leads to more in-migration to our state, people moving here to live here, which creates more housing sales. And then, directly relevant to us, is the need for more office buildings, and the need for more industrial buildings, and the need for more experiential retail, and the need for more single-tenant retail. Now we're going to roll back to what it looked like inside Strive in 2020. So at the top of the slide here, you'll see that column is single-tenant properties, this column is multi-tenant properties, and at the end are totals. So in the year 2020, we sold 77 retail properties for a total of $281 million in total consideration. This, you can see, was made up of 52 single-tenant assets and 25 multi-tenant assets. Now I would like to talk a little bit about Bailey Brower. They are one of our sponsors. We do our best to stay away from litigation attorneys. However, as good business people, we know that it's smart to keep them close just in case you need them. Alex Brower is a litigation attorney. He focuses on commercial real estate. He is a friend and a great guy. He has helped us when we've gotten into scuffles and seamlessly helped us. Their firm is well known across the state of Texas as one of the best litigation firms out there, and we are grateful to have Bailey Brower as a sponsor and a close ally to Strive. Now I'm going to hand it off to Kyle Roselle.
My name is Kyle Roselle. I focus on single-tenant retail product in the Houston MSA and had the pleasure of recently moving down to Houston to open up Strive's second office. One of Strive's pillars that we live by is that we pride ourselves in being a technology company that just happens to sell real estate. What I mean by that is that we've realized there's an unlimited amount of data out there, and one of the best ways for us to be of value to you all is by capturing, storing, and modeling that data so that you and your company can then make fact-based decisions. With that, we are proud to introduce to many of you for the very first time, iStrive. iStrive is a proprietary internal database where we house not only Strive's own sales comps, which equate to just under 1,000 properties worth about $3.6 billion, as well as our 43 current active listings, but also houses the nearly $24 billion worth of sales comps that were sold externally, as well as tracks the nearly $7 billion worth of current inventory in the marketplace today. We can then slice and dice this information in unlimited ways, but for the sake of the presentation, I will go over just a few examples of what some of the more useful searches are. The first example being current listings. Let's say you are in the marketplace for something in Houston, retail specifically, multi-tenant only, and you have a minimum cap rate threshold of a 7 cap. Well, we can run this search, and as you see, there are currently 77 properties that fit that criteria. On this page, we can go over some of the very basic financial information of each asset, and if one of them piques your interest, we can then click on the property hyperlink, and I can email it to you for further evaluation. The second example is recent sales comps for a specific product type. For this example, we wanted to know recent sales comp information for multi-tenant product in DFW. So we chose market as DFW, status is closed, again, category is retail, type is multi-tenant, and to pull just recent, I set a boundary of anything that traded between January 1st of 2020 through December 31st of 2020. Ran that search, and as you see, there were 75 properties that traded last year. We can go over some of the very basic information for each asset to see how it compares to anything in your portfolio, but as well as we can go over any of these averages up here for each statistic to really get a better understanding of what the data is truly trying to tell us. We can do the same thing for single tenant, but with single tenant, we can even dive deeper into tenant subcategory. So as you see, we have every filter for every tenant subcategory, but for this example, we chose fast food. Again, everything's the same. Anything that traded from December 1st of 2020 or January 1st of 2020 through December 31st of 2020. And as you can see, there were 90 fast food properties that traded last year. The last example is very simple, but might be the most useful. And that's when we want a better understanding of specific rent comps for a specific area or even a specific tenant. For this example, we chose 7-Eleven, and then I sorted by year built so that the newest ones are on top so we can get a really good gauge of what some of the recent rents 7-Eleven has just signed. So these were just a few examples of what we can do in iStrive, but we truly built this database to be of service to you all and are excited to help out in any way. I will now hand it over to my partner, Jennifer Pearson.
Thank you, Kyle. Now I'm going to talk a little bit about one of our sponsors, First Commercial Realty Group. First Commercial is an impressive company led by a man named Mike Pauley. However, you will not find Mike's name anywhere on the website. They are a property management firm. They manage over 40 million square feet of properties. They handle retail, single tenant and multi-tenant, industrial, office. They are a top-notch property management firm. The way they behave as a company comes straight from Mike Pauley. He is a stand-up guy. We feel very comfortable handing our clients off to First Commercial. Look for the logo when you Google them that you see here on your screen, and please reach out if they can help you at all from a management capacity. Now I'm going to hand it off to my partner, Will Merritt.
Thank you, Jennifer. Hello, everyone. My name is Will Merritt, and I focus on single-tenant retail in the secondary and tertiary markets in Texas. As you can see, here are the single-tenant transactions for 2020. In 2020, there was absolutely no slowdown for demand in single-tenant retail. Over 200 more single-tenant deals transacted in 2020 versus 2019. What we can see is that more and more investors are looking at triple-net deals as a safe investment with long-term stability and cash flow. Except for dining restaurants and gyms, every single-tenant asset group thrived during 2020. If we go to the next slide, you will see the transactions by market in Texas for 2020. Every market increased their overall number of transactions, with Dallas having the highest percentage of transactions at 33%. The secondary and tertiary markets in Texas, which include West, East, Central, and the Valley at 26%, Houston at 23%, and Austin and San Antonio at 17%. If we go to the next slide, we see where all of the buyers of Texas single-tenant retail are coming from. You will notice that over half of the buyers for Texas single-tenant are local Texas buyers. This was much different from over a decade ago, when most of the buyers were coming from California, which now is 21% of the Texas single-tenant buyer pool. This demonstrates that most of the buyers for Texas single-tenant retail want to be able to know the market that the investor is buying and to be able to potentially drive to the property, because retail is a tangible asset that you can look and observe at, which is different from stocks and bonds.
There were 218 trades for multi-tenant shopping centers in Texas during 2020, a 30% decrease from 2019, where we saw 312 transactions. Strive sold 25 retail centers in Texas, so we have a little over 11% market share for all of Texas as a whole, and 16% market share here in DFW. If you look at transactions by region, DFW saw 75 trades, or about a third of all Texas transactions, which was down from 125 from the previous year. Houston had 61 sales from 86 in 2019, and Austin had just about a 50% decrease from 33 shopping centers sold to 17. But one thing to point out, Q1 in 2020 was strong. Then the pandemic hit, which put the pause button on virtually everything. So Q2, Q3, they were slow. But then we again gained steam in the fourth quarter, and trades were back up where they started. So if the pandemic didn't hit, we are poised to have another record year for multi-tenant transactions. Furthermore, we have already sold a few in 2021, and currently we have 9 others in negotiation or under contract. So 1, multi-tenant retail sales should be up in 2021, and 2, Strive continues to gain market share. So where are the buyers coming from? 83% of the shopping centers sold in Texas had buyers from Texas, 8% from California, and 10% from all other states, which is the complete opposite of 2006 and 2007, where a majority of the capital flowing into the state was from California. But after the financial meltdowns of 2008, the California spigot basically shut off. This doesn't mean there isn't outside capital looking to buy here. What it means is 83% of the time when a shopping center sold in the state of Texas, a Texas buyer outbid investors from everywhere else in the country. Texas investors believe in Texas and want to invest in Texas. Now I want to turn it over to Jake Dutson, a top retail agent in our Houston office, to discuss multi-tenant trades in that marketplace.
Good morning, everyone. My name is Jake Dutson, and I focus on multi-tenant retail property in the Houston market. And I was also one of the agents to help open our Houston branch for our firm in 2020. And I first want to look this morning at the Houston multi-tenant transactions from 2020 and look at how those compare to 2019. So you'll see the number of transactions understandably dropped in 2020, with the second and third quarters being noticeably slower. We saw businesses needing to close their doors and limited financing being available for shopping centers in those second and third quarters. The fourth quarter did see an uptick in trades. It was pretty active. And what's interesting about the properties that did trade is you'll see the average price decreased while the average price per square foot at close increased. And that tells us that smaller assets were the ones that were trading. And it kind of highlights something we saw in the market, and that's investors were flocking towards quality, smaller retail strips rather than anchored shopping centers. And if you look at the average rent per square foot at close and the occupancy at close, both stayed consistent as these smaller COVID-resistant assets performed better than the market averages this year. The average rent per square foot and the occupancy in the market as a whole did not stay consistent from 2019 to 2020, but the assets that traded did. Now, the cap rates, average cap rate in the Houston market last year increased to over an 8 cap, and we attribute this to increased motivation from sellers who may not have been as prepared to be as hands-on as necessary last year, and we saw buyers with strong management groups and tenant relationships take over these properties at higher cap rates. Now, if you look at historical multi-tenant cap rates, they've been steadily compressing since the Great Recession. We did see an uptick in cap rates in 2020, but we expect 2021 to see cap rate compression for three reasons. One, with multiple vaccines being rolled out, we believe the healing is beginning. And two, as we heal, the pent-up demand will start to express itself through increased retail sales, including shopping, dining, traveling. And three, we expect interest rates to stay low for the foreseeable future, which will increase investment activity. Now, if we look at single-tenant retail transactions in the Houston market and look at the year-over-year trends, we'll see that the number of transactions is up from 100 in 2019 to 133 properties in 2020. And investors were looking for the long-term stability. There was financing available for these assets, and we saw 1031 exchange activity noticeably increase in the fourth quarter as uncertainty started to grow regarding change in presidency. And what drove some of these averages last year, such as cap rate, were the subcategories being targeted, such as fast food versus larger footprint concepts like fitness centers and department stores that were not being targeted. And the supply of COVID-resistant single-tenant net lease properties could not keep up with demand, so we saw the cap rates compress. We also saw 29 dollar stores trade hands in 2020, up from 9 in 2019. So that subcategory saw cap rates compress. Now, historically, cap rates in the Houston market have remained stable the last few years. 2020 averaged a 6.11 cap at close, and we expect this trend to continue with investors targeting the stabilized long-term cash flow that single-tenant net lease investments provide. Thank you very much, and I'll now hand it over to Hudson.
Thank you, Jake. My name is Hudson Lambert, and I focus on multi-tenant shopping centers in Dallas-Fort Worth. And that's where we're transitioning now. We highlighted some of the trends and changes in metrics year over year from 2019 to 2020 for shopping centers in the Metroplex. Our first metric is number of transactions. This decreased drastically because of the pandemic. From March until July, virtually nothing in the multi-tenant space was happening. With a lot of confusion around COVID-19 and the viability of tenants, banks just weren't comfortable lending any money. The average price per transaction increased, but this number is skewed because there was an abnormally large trade that happened in Dallas that was just shy of $200 million. So not counting that trade, the average price is unchanged at $8.2, $8.3 million. This may be surprising to some of you guys, but the average cap rate compressed 56 basis points. We were on the front lines of this as Strive exclusively sold 7 of the 10 lowest multi-tenant cap rates. A combination of lower interest rates, quality new product, and lenders getting bullish on DFW retail played a big part in this. The delta between the asking and selling prices shrunk slightly. In 2019, the delta was 0.45% versus 2020's 0.17%. Both average price and average rent per square foot increased substantially for the properties that traded. The sale price per square foot increased by $81 and the average rent increased by $5.50 a foot. A lot of new construction in North Dallas traded in the beginning of the year, and many of those assets were leasing for over $40 a foot. Combination of quality product, smaller suite sizes, and increasing rents will likely cause this trend of higher prices per foot to continue as more people flock to the Metroplex. The last metric is occupancy, and this is unchanged, but this is only for the properties that traded. This is in contrast to the overall market where we were at 95% occupancy in 2019, and we dropped to 90% in 2020. You'll see in this graph, since the market's recovered from the crash in 2010, we've seen steady cap rate compression. While occupancy levels are lower than normal, we don't expect to see a lot of distressed selling and therefore don't expect cap rates to rise significantly. We believe low interest rates and the population growth in Texas will likely keep cap rates relatively low. Strive had a 20% market share for shopping centers in DFW in 2020. None of this would have been possible without our amazing clients, so we want to thank all of you. We're very excited to watch this market continue to flourish with all of you. I'm now handing it over to my partner, Adam.
Thank you, Hudson. My name is Adam Gottschalk, and I focus on single-tenant product in Dallas-Fort Worth. And I'm really excited to dive into one of the key product types of 2020. I want you all to pay attention to the graph, and I want you to see the constant cap rate compression of single-tenant assets over the last 12 years. It's over 2.5% decrease since 2010. And really in the last few years, our cap rate compression has really been due to the new construction, long-term leases, lack of supply, paired with lower interest rates. Now on the next slide, there are lots of positive metrics to point out here. And as Will explained earlier, there were 236 net lease trades in DFW last year, up 32 from the year prior. Average price went down about $400,000, but that's really just because the smaller assets trading at more aggressive cap rates. Now, average cap rate went down, average cap rate at list went down. The delta list to sell slightly went up, not much, but really that's just due to seller motivation in the marketplace. And then one thing I want you to focus on is the average price per square foot and average rent per square foot. So this number really rose due to 26 7-Eleven properties trading in DFW with the rents being $66 a square foot. And if we take those out, that number is really closer to about 35, but still a positive increase in last year. So like Kyle talked about earlier, we're able to access this information and slice and dice it into different product types to be a benefit to you, our client. So 2020 was the year of the pandemic. So I wanted to break out a graph that showed us the sales volume by quarter. So you can see Q1, 145 million. That number decreased over 63% in Q2. And what has kept us moving forward were the essential businesses and the transactions. So as the market started to open up, so did we see the transaction volume. And I thought this would be an interesting metric to point out as well, but 236 total trades in 2020, 56 of those were just in the month of December. So people closing out their books before the end of the year. And like last year, I provided a graph and subdivided our single tenant product into types and where the cap rates have changed in the last 3 years. So if you remember, our big pillars for pricing and cap rate valuation derive from location, term of the lease. So is it a short-term, long-term, extra long-term lease? Who's the guarantor? Is it franchisee? Is it corporate? And then the last one's the fundamentals of the real estate. So are there annual increases in rent? Are there fair market value bumps? What does that look like from a fundamental standpoint of real estate? And so last year we saw big decreases in auto parts, dollar stores, drugstores, and restaurants. We know that banks have been consolidating their stores, and so those cap rates and the uncertainty of where banks in their future we don't know where it is, so those cap rates have kind of gone up. And then fast food, I just wanted to point out that we saw a slight uptick since then the majority of the sales were franchisee credit from the year prior, but not a lot. And the dollar stores, the drug stores were our darlings of 2020. We saw some of the biggest cap rate compressions that last year. And also restaurants. Restaurants saw a decrease, but really it's because the sample size was so small and the rents and the cap rates were so compressed for those. So they were corporate credit tenants like Cracker Barrel, Olive Garden, Buffalo Wild Wings. But other than that, that sums up our year. And I'll hand it over to Jennifer next.
Now I would like to take a moment to talk about one of our sponsors, AEI. AEI is a consulting firm. They handle environmental assessments, surveys, property condition reports, and they have a whole suite of services. We refer a lot of people to AEI because we trust them. They're very good at what they do. They respond quickly, and really they make us look good. If AEI can help you, please feel free to reach out to them. If you Google them, you'll see the symbol there and you'll know it's them. And now, without further ado, I would like to introduce our keynote speaker who really needs no introduction, Mark Dotzer. Mark was a real estate economist for Texas A&M. He is now on his own and traveling. He is really fun to listen to. Mark is great about making economics interesting and understandable. So I will turn it over now to Mark Dotzer.
Okay, that's great. Thank you very much. Happy to be here with you this morning. The report that we've just seen is really interesting and useful, and it's fun to be with y'all today. Rush, let's go ahead and get started. The theme of my presentation is called Choppy Waters After the Storm. And obviously, I know the storm isn't over yet, but it will be this year, I hope, and am basing my forecasts on. And so with that said, let's go to the next slide and get started here. This is what I see happening, is that we just have this COVID hangover where everybody's sick of doing what they've been doing. Just looking at that girl, that woman at the top at the office, the mom with the kids, the young man looking out the window, the students, and just thinking, what would they like to be doing instead of what they've been doing for the last year? Next slide, please. In addition to just not being able to do what we want to do, we're saving all kinds of money. That last helicopter drop of money back in the spring or last summer, whenever that was, it went right into the bank account for the most part. That's why we don't have any inflation, because you can drop money all over America, and if people put it in the bank, it doesn't do anything for the economic growth or inflation, period. And I expect to see this same spike again. But the bottom line is there's a lot of money. And for in economics textbooks, they have a phrase demand, and that means I want to buy something. But there's another phrase in there called effective demand, and that means I want to buy something and I have money to do it. And Americans are going to have money to spend, and they will spend it. Next slide, please. And the question is when? And I've thought a whole lot about this, and in my mind, the economic recovery is going to be virtually 100% correlated with the percentage of Americans that have received the second dose of the vaccine. I'm calling it a get out of jail card. People are in jail. All those people that I just showed you their pictures of, they are in jail and they don't like to be there and they can't wait to get out. And so I think every month that goes by that we find out more people get the vaccine. I found 2 websites that are actually monitoring this every day. That's going to be my #1 economic monitor, because I'm convinced our recovery will be almost perfectly correlated with that number. Right now, it's very few. Our government has been very ineffective, basically a failure at taking care of this up to this point. I hope maybe we can do something other than fail. I have no confidence in the federal government, and I don't like the Republican Party or the Democrat Party. They're both incompetent failures in my mind. But I'm hopeful. Maybe we'll get this right, and I hope so, because it's about, I'm saying, $600 billion a month in lost economic income that goes by that we don't have this virus out in the public. So if it's later in the summer, we'll have another helicopter drop of another $2 or $3 trillion. And ultimately, that's not good for the country. Next slide, please. So this is what I see happening. That's why I used those pictures of those boats. That boat was going straight down, and it's going to go straight up again. This is a picture of Black Friday years ago, when Black Friday was just one day. But just look at the joy and the energy on those people once the gate is opened. And I'm calling this the go signal. And when Americans get the go signal, this is the kind of energy I could see coming out. And you thought there was pent-up demand for toilet paper and Clorox wipes back in April last year. Think about the pent-up demand for all kinds of things. I have a feeling, so we had shortages of toilet paper. We had shortages of Clorox wipes. Hard to buy a bicycle, hard to buy a Peloton, hard to buy an RV. I think we could have pent-up demand of that magnitude and a whole lot of other things that we can't even anticipate at this point. Next slide, please. That's why I say it's going to be choppy waters, because, new clothes. When you're at home, you don't need very many clothes, but a lot of people are probably sick of their clothes by now, and go out to a restaurant, take a vacation, have a real wedding, or have a real funeral, or go to a convention, or move into a new house or apartment, or go back to school. Just all of that kind of stuff. pent-up demand like we haven't seen. My guess is, I'm 66, but I don't think we will experience the kind of pent-up demand we're going to see here probably in the second half of this year in my entire lifetime. I would have to go back to the month after World War II was over, because the government was rationing everything at that point. People didn't have any way to spend money. They were saving it. And when it was over, there was a lot of joy, a lot of energy, and the klaxon horn rang, and the people came out and started living life again. And I see that happening this year, unless our government just can't handle getting vaccines out. Next slide, please. The problem is in the supply chain. The supply chain is really in trouble all over the world. If you wonder why you order something on Amazon or any place else over the internet and they tell you they have it, then they tell you it's back ordered, then they tell you it'll be delivered in 3 weeks, and it's not supposed to be delivered until 3 weeks, and you get it 4 days later, or they tell you it's going to be 4 days and you get it 3 weeks later. The supply chain, unfortunately, I got this picture of this young man delivering the vaccine, and that's a UPS guy who is also delivering returns of Christmas presents. So this guy is distracted from saving our country, which is bleeding about 600 billion in lost economic activity a month. And we're relying on FedEx and UPS to deliver the vaccines here. If I was president of the United States, I'd say, you know what, FedEx and UPS, you're not delivering anything but vaccine for the next 60 days. And all you retailers will accept returns from Christmas presents all the way until May. And they have the power to do that, and they should do that. But it's just sad to watch this and see, because we have this supply chain problem in the vaccine as well as everything else. Next slide, please. People are already buying stuff. I mean, it's not like there's not pent-up demand already. Everything that we buy from China, which is virtually everything, they're our subcontractor. So they ship it through Long Beach, and Long Beach and LA ports set a record. So we've already got an amazing amount of economic activity going on. And it's going to get bigger than that pretty soon. Next slide, please. Shipping costs are going through the roof. This could cause a change in the view of using warehouse space because the shipping is just out of sight. This is a hockey stick. This is what it costs to get a container from Shanghai to other places in the world. So shipping costs are going astronomical, and this is going to be a cause of inflation of a temporary nature, which won't impact cap rates, by the way. We'll get to that later. Next slide, please. This shipping costs, that was for container ships. This one's for liquefied natural gas ships. Same thing you can see. So somebody's going to get squeezed. Somebody is paying an enormous cost for shipping. And so far, they at least haven't been passing it on to the consumer. Although I say that and then I hesitate, thinking, because anything I buy on the internet, you have no idea if you could buy it cheaper at the store. And I see that sometimes you don't. And also I see that sometimes you buy stuff on the internet and find out it's a fake. I've done that. My son's done that with jigsaw puzzles. You get fake jigsaw puzzles off of Facebook or Amazon, and they come and they're so paper thin, if you sneeze, the whole puzzle just flies up in the air. So I'm going to be thrilled to death to go back to a real store and buy something from an American person that has a retail store that pays property taxes and sales taxes and creates jobs. And I hope we stop buying stuff from Amazon, because every dollar you spend at Amazon is just destroying retail in this country. And some people like that. They want to disrupt stuff. Okay, great. Disrupt it all. Then you figure out how to replace all the lost tax revenue. Next slide, please. Home prices are skyrocketing. Next slide. And there's not enough supply, and there's going to be enormous demand, and supply will never be able to catch up. That's a story for another day. I probably talked about that last year. But the same conditions that have caused inventory of homes to be way low haven't changed a bit. They're still way low. There's not enough subdivision development. So home prices are going to continue to escalate. So I think we could see temporary demand, and I want you to underline in your mind that word temporary, because temporary inflation does not cause interest rates to go up. I mean, we could see in the next 6 months rates go up a little bit, but that will be because there will be people that confuse temporary inflation with longer term inflation. But just a simple example is gasoline, where I live down here in College Station, is $2 a gallon. When the klaxon goes off and everybody gets the go signal because they got the get out of jail card, I could see gasoline going from $2 to $2.80 within a matter of weeks. And when that happens, that's 40% inflation in gasoline, and similar things for other products. But here's what you got to remember. Yes, that's temporary inflation. So if the price of gasoline goes up to $2.80 a gallon in August, what happens a year from now in August of 22 when gasoline is still $2.80 a gallon? And a year after that when it's still $2.80 a gallon? That's 0% inflation again. That's why long-term interest rates are unlikely to go up much. And that's why I think cap rates for commercial real estate, depending on the risk, you could see further cap rate compression. Where you're seeing cap rates going up is because the perceived risk of real estate is changing a lot has changed a lot in the last 12 months. And we'll talk about that a little later. Next slide, please. Texas just becomes an enormous magnet. U-Haul measures loaded U-Hauls where they're going and empty U-Hauls where they're coming from. And the empty U-Hauls are in places where nobody wants to live anymore, like California, Illinois, New Jersey, Massachusetts, and Maryland. There's your 5 bottom ones. And where are the people going? That would be Tennessee, Texas, Florida, Ohio, and Arizona. And I'm blaming this on Blake Shelton and Gwen Stefani. I watch The Voice with my wife. It's about the only TV I watch besides sports. And I somehow or other Tennessee snuck in there, because when you read the fine print in this chart, in this slide, it says that Texas and Florida have been number 1 and number 2 for 4 out of the last 5 years. And I bet next year we'll be back there toward number 1 or number 2 again. Bottom line is people are moving here, and they're going to continue to move here because they realize how miserable life is in some of these other states. Next slide, please. So higher inflation could cause mortgage rates to go up a little bit because they're tied to the 10-year Treasury. Some of you on this call are old as me or older than me, and you've been worried about runaway inflation since 1990. And I've been trying to talk you off the ledge for the last 20 years. We're not going to have higher inflation, and we're still not going to have higher inflation. But there's going to be a natural pressure for investors to think that's going to happen. And when that does, they want to buy more real estate. And the Fed, here's the thing you got to know. If interest rates go up at all, you know what the Fed will do? They will start buying all the 10-year treasuries and all the mortgages in this country. And a 30-year fixed rate mortgage could easily drop to 1.5% if they want to make that happen. I don't see that happening until we have the next recession, which I hope isn't for at least another 5 years or 7 years. Next slide, please. I think we're going to have a combination of a early V-shaped recovery and then a jobless recovery. If you look over on the far right, you can see we had a little bit of a V-shape once we got out of that lockdown. That lockdown of our economy by the government is going to be the biggest mistake in 100 years that the federal government has ever made. They are totally incompetent. They never do anything right. And I've known that for decades. But this one tops them all. Locking down the economy because some doctor said you have to, and the World Health Organization, who later said lockdowns were a huge mistake. I think the likelihood of us having a lockdown like that again is 0, because they know it was a complete disaster that's going to take us years to come out of. But so we're having a rebound. When we took off the lockdown, people went back to work. And when people get a go signal and start wanting to go do things like we've already talked about, we'll get another V up leg, but probably it won't get, I'm an economist, means there's a 50% chance everything I say is wrong. So when I say it won't, keep that in mind. I don't know. Economics is a soft science and everybody knows that. But what happens, a jobless recovery just means we have jobs growth, but just not very much. And what I want to show you is it doesn't matter if a Republican is a president or a Democrat is a president. They can't do anything to make this economy grow any faster than it's going to grow on its own. Next slide, please. And I want to show you this one because I found out that tax cuts don't matter either. So those yellow boxes up there show you they're placed there strategically at the time when some kind of tax reform, including tax cuts, happened. And as you can see here, tax cuts are irrelevant too. So my conclusion is, so if Joe Biden and the Democrats decide to raise taxes a little bit, it doesn't matter because the tax cuts didn't matter either. All it means is we're likely to have another, quote, jobless recovery, which just means we'll get more jobs, but it'll take us a while to get back to where we were in 2019, longer than we'd like. Next slide, please. This is why people feel like it's a jobless recovery, because this is the percent of job growth in America, but it goes back 60 years. Same chart I just showed you, only 60 years. And back in the 80s and 70s, we would grow 5% a year, but now 2.5% is about the best we can get. Why is that? Because we chose to give away a lot of our jobs and wealth to Japan back in the 80s when we outsourced all our electronics. We chose to share a lot of our wealth and jobs with Mexico, and we outsourced clothing and furniture and automobiles down there. And we chose to outsource and give away jobs and wealth to India when we outsourced information technology back in about 1998. And we have chosen to give away a lot of our jobs and a lot of our wealth to China. We, through our magnanimous approach, have allowed China to become the second largest economy on earth. But they know, and I know, and a lot of people know, that they're a subcontractor for us and they will treat us fairly. No, they won't treat us fairly because they cheat all the time. They're a communist dictatorship. You can't trust a word they say, but they know it's in their interest to take care of us, because if we decide we're not your customer anymore, China goes back to the dark ages. Next slide, please. So how long is it going to take to get all our jobs back? So if we had an initial V shape, see how that V over there on the far right started to slow down a little bit? We're going to have another V up here this summer, but it won't quite get there. So I went back and looked, and so the last two recessions we had, the one in 2001, took 47 months before we got all the jobs back, and it took 77 months from the 2009. So my guess is there's your range. It'll probably take us, after we have the big V-shaped recovery later this summer, then to finally get back up to where we were in 2019 could take anywhere from 4 to 6 years. Next slide, please. And that's another reason why you don't have runaway inflation, because when your jobs are growing at 2% and you're under full employment, that's not a scenario for inflation. There's great news. I wish Wolf Blitzer with CNN would just come on TV once and say something positive about America, but that's not their business model. I understand that. But there's this was back in November, 10.8 million jobs open. Next slide, please. State and local governments are a concern, and this is why our federal government needs to have one more $2 trillion package, because a giveaway, because states and local governments can't print money and their budgets are under huge duress, and we don't want them to start laying off all kinds of people, because many people on this call, excuse me, remember what happened when cities ran out of money and they had to lay off people in the planning department and the permits office, and it really slowed down real estate development. We don't want that to happen. Next slide, please. Okay, pardon me. I've been on the phone a lot this week. I read the Biden-Sanders Unity Task Force so I could figure out what it means. My clients kept asking me, what happens if Biden wins? What happens if the Democrats win the Senate? All that sort of stuff. Well, I've already showed you it's kind of irrelevant. But there are certain things within there that I think need to call attention to. The first two words of the document are climate change. And right in there, it says we must embed environmental justice and climate justice at the heart of our policy. That is a true statement. And for a lot of you, that's going to be great. And for a lot of you, you're going to think, well, that's no big deal to me. But the bottom line is, it is a big deal, and it will matter. And so all of us just need to recognize the new world we're in, and climate change and green energy is coming for a variety of reasons. And most of you are probably agreeing with me on that. I don't need to get into more of that. Next slide, please. When I read this 110-page document, this is all I could find related to commercial real estate. There was a little more for residential. But the bottom line there is they're going to try to say if you build buildings after 2030, it's going to have net zero greenhouse gas. And I haven't talked to architects or builders to know what that does to the cost. But for people that are planning new developments into the future there, that might help you make a decision about, do we want to have our building come up before 2030 or after 2030? And there's some opportunities to get tax dollars to retrofit buildings for zero emissions as well. And they're going to try to get states and cities to add more building codes, which we all know anytime you add a building code, it just adds the cost to every kind of project. There was no mention specifically of the 1031 exchange, but let's go to the next slide. When they were talking about, let's go to the next slide, please. In the Biden-Sanders platform, along about page 95 or something like that, they're talking about taxes and the Fed. They're talking about getting rid of capital gains taxes for people that earn over $400,000. And these are all direct quotes out of them, by the way, and bringing into expensive tax loopholes. So my guess is that is a target on 1031. My guess is that when Donald Trump's taxes were revealed, he didn't do anything wrong. I mean, all I saw in his tax returns was, this is the beauty of owning real estate. You can create wealth and defer paying taxes. And with 1031s, you can defer them indefinitely. So I have clients that are major accounting firms that advise everybody on earth that this is what you do with real estate. So there's nothing wrong with it, but a whole lot of the American people found out it's like a rich guy that's big in real estate isn't paying any tax. And so I'm guessing that if there was ever going to be a year where the 1031 would be under serious duress, I would say it would be in this calendar year. So you might want to pony up, if you're a big 1031 fan, you might want to pony up money for the National Association of Realtors or somebody else that's got a lot of clout in Washington, because I think you're going to need it this year. Next slide, please. And as some of the people in Congress, Democrats and Republicans, want to amend the Federal Reserve Act. That's not going to happen. I don't even want to get into that because it's just preposterous. But it just I just want to illustrate how preposterous these government people are, because if they even mentioned that they wanted to amend, it's in the document, it's in the Biden-Sanders platform. And then here's a real politician, a Republican, that wants to do the same thing. If that gets out at all, that Congress is even going to consider amending the Federal Reserve Act and changing their dual mandate, I could see the stock market drop 10,000 points in a matter of a couple of days. And then they would say, we were just teasing. No, that was a typo error. We're not going to do that. And the market would go back up 9,000 points in one day after that announcement. But I don't think they're that dumb to do that. So probably won't even happen, but it's out there. Next slide. I just like to know what they're thinking about. I'm not a political scientist, but being old enough, I know that politicians like to take care of their donors. They treat their donors really nice. And if you're not a donor, they don't have the same interest in treating you nice. And so I saw this the other day and I thought, well, this kind of helps you see what industries are going to be protected and encouraged and which industries aren't. And I see Wall Street at the very top of the list. So I'm guessing there won't be a whole bunch of bank reform, bank regulation, or anything to do with that would affect Wall Street at all. And communications and electronics. So all the big firms like Google and Alphabet and all the rest of those, Facebook, you name it, they're going to be kind of in the protected class as well. Might be a lot of talk about them, but when it comes time to do something, just look at this chart. Lawyers and law firms. So you can see where the major donations have come from. And then you look at the bottom of this chart and I see real estate, construction, oil and gas, and transportation. So I'm guessing that those industries on the bottom half of that chart will be treated a little less favorably than those on the top half of the chart. Next slide, please. So let's talk about commercial real estate. I'm still bullish on commercial real estate and for a wide variety of reasons. Next slide, please. The first reason is money's just continuing to flow in. I think probably for the last 12 years, I've been saying, if you think there's too much money chasing deals now, well, there's more money coming in next year. And I've been saying that for a decade because it's true, and it's still true. Blackstone raised $8 billion for their largest ever real estate debt fund. Next slide, please. And in addition to that, my buddies, my clients and friends in private equity, they got $204 billion in dry powder right now. Dry powder means you went out and raised the money from a bunch of high net worth investors, promised them you'd buy real estate and make them big money, and they can't invest it yet. It's sitting there. So I view these people as distressed buyers. And so even if there is any distressed real estate assets in the country, I think this dry powder will mitigate any price declines that you might see. Next slide, please. Another source, a third source of income, additional energy flowing in, money flowing into real estate, our pension funds, life insurance companies, and endowment associations have raised their allocation to real estate again. They do it every year. Back when I was getting my PhD at the University of Texas in Austin in the 80s, pension funds didn't put any money in real estate. It was all stocks and bonds. And then they dipped their toe in the water, 5%. Since let's say 1988, 1990, it's risen from nothing to where it is today, growing again to 10.5%. And there's a lot of money in these major institutions all over the earth. And so there will be, the only mistake these people have made is not having a 20 or 30% allocation to real estate going back to the 1980s. We probably wouldn't have any pension fund shortages if they had done that, but it's taken them a long time to figure that out. Next slide, please. The urban vibe is questionable right now. And I'm speaking to audiences all over the country. And I'm just helping them understand that they need to have conversations with their mayors, because the urban vibe is not a natural equilibrium state. The urban vibe is something that's fun and exciting to be in. And when it's dangerous and scary, there is no urban vibe. And when you don't treat your tax-paying residents and businesses well and provide them with police protection and fire protection, and arbitrarily just say, I'm not going to offer you public services anymore, well, those people will leave. And this is just one example. Walgreens dropping a couple of stores in San Francisco. You know what's happening in retail in downtown areas? I'm hearing from people, this is hearsay, but because I doubt if I'll ever get anybody to admit it, but I've heard that the police and the criminal justice system, the district attorney, whoever it is, around the country are starting to raise the dollar amount of shoplifting that they'll prosecute. You know, it's like, okay, well, if it's under $400, we don't prosecute. We just get mad at you and send you home. Well, if they raise it significantly so that the people find that out, there's going to be more of this go on, and there's going to be more people leaving the urban environment. And these mayors around the country, if they're not smart enough to know this, they need their constituents to say, you will offer us police and fire protection, or you will be removed from a mayor's job. And maybe I might even sue the city for damages because you basically took the value of my business away from me without compensation. And I'm a taxpayer, and you're going to pay me back. And I hope they do. Next slide, please. This is just an example of what happens here. The police people that are quitting in Seattle say it's an absolute joke. All right. Well, when your police feel that way, well, enough said. You get it. And I'm going to be right up front and say, you know, if a cop kills someone, murders somebody, they should go to jail. And I don't care what their union says about it. You go to jail. And peaceful protest is protected free speech and freedom that this country is known for, that I cherish a lot. But Breaking into somebody's shoe store or somebody's restaurant and stealing all their inventory and setting their building on fire, that is not protected free speech. That's called anarchy, chaos, violence, and crime, and should be prosecuted to the max. And we saw too much of this go on this past summer. And now people must think, hey, it's okay. You can go you can go burn up a building. Nobody cares anymore. And this urban vibe is in jeopardy. And if these mayors don't get it right, you can lose the urban vibe for decades, and it will continue to exacerbate the movement out to the suburbs and smaller communities. Next slide, please. The good news is a federal judge is allowing people in Seattle to sue Seattle over their negligence of providing police protection to them. So I'm happy. I hope this works well for them. And I hope cities all over this country shudder a little bit and think twice about not offering police protection to tax-paying people that live in the community and people that work and have businesses in the community. Next slide, please. Without the businesses, without the customers, you've got no urban vibe at all. And I remember what it was like in the 1980s to be in New York City and Chicago. It was scary, period. And so after years and years, it has been a lot of fun. And there's a reason it's fun, and that's because those mayors provided police and security so that people had fun. You didn't have to be afraid. So there's a lot of movement to secondary markets for investment. The primary markets were overcooked. The yields and cap rates were low in the primary markets. And all of a sudden, COVID came along and people said, I don't think I can live and work in New York City. I don't want to be on a subway anymore. I can't get up in an elevator anymore. And that started pushing people out to secondary markets and suburbs. And then this loss of the urban vibe is another one. And so there's a lot of reasons why people are kind of contemplating or actually acting and moving away from downtown cities into suburbs and surrounding communities. I think there's a lot of development opportunities within a 60-minute radius of any major urban area. 60 minutes, not just the 45 that we're used to in the past. Next slide, please. The housing market's on fire. I mentioned this last year at this meeting and every meeting I spoke at last year. This is all orchestrated. I didn't have to be a genius or crystal ball. This is all according to Federal Reserve plans that if we have a recession, they'll drop interest rates and they'll make mortgage rates go low and inflate the stock market and inflate the housing market. And it's working perfectly. I mentioned last year that they could make mortgage rates go down to 2 or 2.5. Well, they didn't have to. They got down to 2.8, 2.9, set the housing market on fire. Houses are escalating at abnormal prices. And so there's no reason for them to lower mortgage rates any lower than they are now. But know full well and good that the next recession we have, they can easily take the 30-year mortgage rate down to 2 or even 1.5 or 0, actually. Denmark did that. Denmark had negative interest rates for a 30-year fixed rate mortgage for a while, a couple of years ago. Next slide, please. So what's going to happen is investors are buying up houses too, and there's no inventory. So if you're just a nice family, everybody's a nice family. If you're a family and you want to buy a house, you go out in the market, and normally we would say a 6.5 months worth of inventory would be a normal market. And now most of them are under 2. And I gave a speech in Austin a week or so back, and they don't even have 1. Inventory of homes available for sale in Austin is 18 days. That's just insane. And so anytime you have inventories below 6.5 months, let alone 1 or 2 or a half a month, prices are going to escalate dramatically. And so that's going to allow apartment owners to push through rent increases too, because the cost of owning a house is going to get expensive, even with 2.8, 2.9 mortgage rates. Next slide, please. This is just happening. It was common sense with COVID that people would move out, but with urban violence, it's causing even more. So again, I think the trend towards suburban movement of retail and apartments and warehouse that goes with all of that, that trend is going to be I would say, very highly correlated with how many stories we see on TV of people breaking into businesses and destroying businesses. It's cold now this time of year, so that's not much fun to do that. But when it starts warming up again, if these people start breaking into businesses and stuff, it's just like, okay, so your team wins the Super Bowl. So you go out and set a building on fire and turn a couple of cars upside down. We've been allowing that to happen for a decade or more. But now it's like anything that happens, you get mad, you go out with a bunch of people and you set buildings on fire and break into buildings. To the extent that our mayors and police let this happen, this suburban thing is just going to continue to explode long after COVID is way over and a distant memory. Next slide, please. The biggest unknown to me, and I'm anxious to visit with the people at Strive, I don't have the answer to this. I know what's happening to foreclosures of single family homes, and that's not going to happen. So you don't have to really worry about that. But what's going to happen to building owners that haven't been receiving payments, and what happens to them when they are unable to make their payment on their mortgage, whether it's CMBS or some other kind of loan, I don't know the answer to that just yet. And that's kind of the $1 million question. Nobody thought that a government could shut down your business and call you not essential. That was disgusting. That's so offensive to me. How would you like to be an immigrant family, say from Vietnam for fun, and you came over here and you've been working your rear end off for 25 years. You've got a growing business and you've got your mom in there, you're in there, your wife's in there, your kids are in there, and some babies are in there hanging out too. And you are paying your way and putting your kids through school. And then some health department person or mayor or governor says you're not essential and you can't be open. I mean, I can't think of a more horrible thing to say to somebody in the United States of America. If it's your business and your future and your hopes and dreams, it's essential. And just because the pot dispensary and the liquor store are essential for obvious reasons, that's just such a slap in the face. I just can't believe this is happening. And I hope a whole bunch of people sue the government for losses related to this too. This could be the gigantic class action lawsuit of our century, and I hope it happens. Next slide, please. There's only two paths to inflation, and neither one of them are going to happen. And I want to just mention briefly, let's go to the next slide. Path number one is what a lot of you that are as old as me think might happen again, and that's like what happened in the 70s. And it can't happen. And I put down here a little list of bullets. In 2021, you can't have this kind of inflation unless you print money continuously and make people spend it. We're printing a lot of money right now, but nobody's spending it. They're saving it. That's not inflationary when you put it in the bank and don't do anything with it. And in addition to doing that, we'd have to shut off all imports or put on huge tariffs all over everything that comes into this country. And we'd have to tell companies, you can't send your workers overseas anymore. You got to bring them home. You can't do business in America if you have one worker in a foreign country. And another possibility is to have a communist revolution where the true communists of the country overthrow the fake communist dictators that are in power right now. None of that's going to happen. So I'm discounting this totally. Let's go to the next and last slide. And that would be path number two. And this could happen. It feels like it's trying to happen, but it's not yet. And I'm hopeful that it won't. But what happens here, I call it what happens when the medicine stops working. And we could see that pretty soon, because if Congress comes out and says, hey, gang, we want you to know that we're really working for you, the American people, and we're going to have a CARES Act number 2 that's going to be $1.3 trillion, and all of you are going to get another check. And won't you love us as politicians? Well, over the last 15 years, whenever they announce a helicopter drop of free money like that, the stock market usually goes up several thousand points. And it seems to continue to do that. Let's watch and see, because I'm guessing that that will happen again. When Congress does something in the next 2 or 3 months, I bet the stock market will be up another 4,000 or 5,000 points. But there comes a time over the centuries, there's a time when it stops working. And how that would happen in America is Congress would announce this new $1.9 trillion, and here's $1,200 per person. and the stock market falls a couple thousand points, they'll start scratching their head about that. And then what happens is the dollar falls and people don't want to own dollars, and they start buying Bitcoin, and they start buying a whole lot of real estate, and money tries to flow out of America. And this is where it all breaks down, because money cannot flow out of America right now because there's no place to go. Where would you, if you went to the bank and took out all your money, would you put it in Iran? Or how about a communist dictatorship like China, where they can take your money overnight without your permission? Or how about India, or Japan, or any place else? There's no place to go with, or maybe you could go to Europe and get negative interest on your bonds. There's no place to go. So this threat of inflation is virtually impossible too. So that's my conclusion is that there's almost no chance of having inflation, which would cause the 10-year treasury to go up very much. And that's what would cause cap rates to go up as well. So with that said, that's the end of my prepared remarks. And I would be happy to field some questions if we'd like to do a little Q&A session.
Hey, Mark, thank you. You're always very informative and extremely entertaining. So there's a handful of questions that have come in. A lot of them you have answered, so thank you very much for that. One question that was asked was, the cost of land in Texas continues to go up. The cost of construction continues to skyrocket, and also the cost of labor. So how do you think construction costs will ultimately affect commercial real estate here in Texas?
Okay, that's a great question. In terms of the materials like lumber and steel and stuff like that, I think that's temporary. There's a lot of demand, and that was not a surprise to me. But there was a lot of demand, and some of these plants shut down because of COVID or whatever other reason. And so you've got a temporary imbalance where there's too much demand, not enough supply. So you're getting spikes in prices. For those of you that ask that question, you know this too, that lumber prices skyrocketed after Trump put a tariff on lumber. You remember that? So what happened? The price of lumber went up, and a couple of builders in Houston emailed me and said, hey, you said there's no inflation. Well, what about lumber right now? Blah, blah. And I said, yeah, well, okay, I get it. Let's wait and see what happens. Well, what happened to the price of lumber? It skyrocketed temporarily, maybe a year at the most. And all of a sudden, guess what happened? All kinds of lumber yards all over America opened up, and the price of lumber went back down to the same price or lower than it was before we put the tariff on. So I wouldn't be too alarmed about, they are high this year, but I don't think you're going to see escalations in costs on that side of it going forward, because lumber and steel will open up production, and that will take care of these price increases and probably drop prices back down. The labor part of this thing is maybe here with us, because one of the big pushes in the Biden-Sanders unity platform was to unionize as much of America as possible. And there's nothing wrong with labor unions, but what that does do then is increase the cost of labor. So I think the Biden administration is going to be pushing for unionized labor. So I could see some labor strikes. Maybe teachers go on strike because they don't want to go back to class. I don't know, but when you encourage that sort of thing, it will come. So I think the cost of labor will go up more than we've seen in recent years. And then the cost of land will do nothing but continue to go up unless we have some kind of gigantic depression in this country. And I don't see that happening yet. And what I do see is I see all these people moving to Texas. I see the U-Haul numbers. I see the Atlas Moving van lines numbers. I see Elon Musk driving one of those U-Hauls from California. Maybe he's toting a rocket on the back of his U-Haul coming into South Texas on I-10. People are coming in, and so the land development can't keep up with it. We're going to have a continuous lot shortage for when it comes to single-family homes. And so I expect land prices to continue to escalate in value. So are there other questions?
There are. I'm going to read one that came in.
Okay.
This is from John Menkes. Oil prices are low and are forecasted to stay low, and fossil fuel in general is losing importance. How will Texas replace this royalty income in order to fund infrastructure necessary to keep up with the exploding population?
Well, number one, I think it's going to be interesting to see how long oil prices stay low, because it's really hard to get. I'm guessing it's going to be pretty hard to get permits to drill for oil in a lot of places. And that means that new production is going to slow down at the exact same time that demand for gasoline and jet fuel is going to go through the roof. So I wouldn't bet a dime on oil prices staying low. If you're an environmentalist and you would like to get rid of fossil fuel in general and replace it with wind turbines and solar panels, the only way you can do that is make those things really cheap, and they haven't been able to do that yet. So the alternative is you would love to have gasoline be $5 a gallon. And so I bet you most of the people that are big fans of the Green Revolution would be thrilled to death if gasoline went up to $5 a gallon. So I think the jury's still out on fossil fuels. Yeah, there's a big, it's front page news right now. But the fact of the matter is, how much of our economy would go if we got rid of gasoline tomorrow? And so it's going to be a very gradual process. There's going to be a lot of years where we still produce a whole lot of oil and gas. And so I think a little bit of those fears are overblown. But and the question about how will we replace our income that way, it's called taxes. This is how all of our generations have done things in the past. Sometimes people blame millennials for stuff. They'll say, oh, these millennials, they blah, 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 blah. When I hear anybody criticizing a millennial, I tend to step in after that and offer an apology to them and say, you know, I want to apologize to the millennials and the Gen Zs and whoever else fits that category for my generation, the baby boomers, and my dad's generation, the Bob Hope generation, because we were the only two generations in the history of the United States of America that didn't pay our way. We didn't pay enough in taxes to pay our bills, and so we have left the next generations 30 trillion in debt. And we're the first ones to do that. So I understand this question about how do you fund infrastructure, because it's been 30 years or so since we really knew how to do that, and that is by paying higher taxes. So you put higher gasoline taxes on and raise it so you got more highway funds. I don't know why we haven't been doing that for 100 years. And if you have to, you raise the fee to go fishing, and you tell the seniors you don't get a big discount playing golf anymore. It's called paying your own way, and we'll figure that out. Next question.
So this question is about office buildings. After the pandemic and we all have the vaccine and everybody feels safe moving around, do you think office building occupancies go back to the way they were pre-corona?
You know, I field every question that's available. I like taking all the questions, and I don't care if I know them in advance or not. And I enjoy all of them and think of them. This is the hardest. This question I do not know the answer to, and I want to. I've got this question 3 times now in the last 2 weeks, and it just helps me realize here's something I got to try to find out. So my initial thoughts were that people's memories are short. And once the virus is no longer an issue, people will want to come back to work and the office. But the flip side of that is that I think managers of businesses have figured out they can maintain productivity without having people in the office. And that's different than 5 years ago or 10 years ago. And so, and some of these workers would like to live farther away from the downtown area and not commute to work. So I think it's very possible that we will see a true decline in overall demand for office space due to the fact that people will be working at home more often. And I got to tell you, I was on a call with a broker, a big industrial broker, an office broker in New Jersey. And I was talking to him about how I thought people's memories would be short and they'll be back to work and blah, blah, blah. And he said, well, that's not happening here because I've got a tenant in my building right now that's got 7,000 feet that renews in about 6 months. And they're telling me they're only going to pick up 5,000 feet so his feedback to me was, yeah, there is going to be some impact to this. And keep in mind, he's in New Jersey, so you got to, it's really hard to have a positive attitude and live in New Jersey or Illinois. So I totally understand that. But that question is not answerable yet. And it's probably the billion-dollar question when it comes to discussions about commercial real estate investment, is how will office fare over the next 12 months?
Awesome. So one last question, and you alluded to it earlier, but it's the number one question that gets reiterated over this chat. What do you think will happen to cap rates in 2021 and beyond?
Yeah. Okay. Well, there's two things that go into a cap rate. The first one is what's the interest rate on the 10-year treasury? Because people could buy, they can buy real estate, take the risk, or they can just buy a 10-year treasury and park their money there. So if the 10-year treasury went up 2 or 3%, people might say, wow, I don't need real estate anymore. So I got to have a higher return to get me involved in the real estate. I don't see the 10-year cap rate going up much. And so I don't think that pressure is going to come from the 10-year treasury going up. And I don't think inflation is going to be there. So I don't think the 10-year is going to go up. So the only reason that I could see cap rates go up is if the perceived risk of the asset class goes up. So here's my guess based on the logic that I have. There's going to be no upward pressure on cap rates at all because of higher interest rates. There could be upward pressure on cap rates in certain asset classes that have higher perceived risk. And that would be obviously hotel and retail. But you know what? I think multifamily probably has a higher degree of risk now than it had a year ago, simply because we didn't know that the CDC could have a moratorium on evictions and that the federal government could come out and tell people you don't have to pay your rent. I mean, that is a huge risk consideration in multifamily that didn't exist a year ago. So I would see cap rates for retail and hotel widening. And I would see cap rates for industrial and triple net lease sorts of things narrowing because there's too much money chasing deals. And let me close with this thought about that. Suppose there's $10 worth of investment that wants to come into commercial real estate every year. Well, last year, that $10 could be split up with office, retail, multifamily, industrial, hotel. And now a lot of people don't want to invest in retail and they're afraid of hotel and they're a little bit iffy about office. And so what that means is that $10 that comes in next year is going to be funneled directly into industrial and also apartment and also to maybe a lesser extent office. So those are the dynamics that I see. And the bottom line for me is I wouldn't anticipate any major change in cap rates at all for properties that don't have a changed risk profile. I want to thank Strive for inviting me to be a part of this. It's always fun to hang out with people that know what they're doing in the business. And thank you for attending the event. And let's just keep our fingers crossed that we all get a vaccine here in the next 3 or 4 months and we're back to party on.
Thank you, Mark, and thank you everybody for joining. On behalf of Jennifer and I and the rest of the Strive team, we want to wish you the best in 2021 with health, happiness, and prosperity. And as strategic advisors, if we can add any value to your business decisions in commercial real estate, please don't hesitate to ask. All the best in 2021.